For the first time in U.S. history, the average price of a car topped $50,000, meaning even basic new cars are becoming a luxury. Couple that with the recent collapse of the used car seller and auto lender Tricolor, as well as the auto parts supplier First Brands, and we're kind of in an interesting position. Wall Street is sounding the alarm. Jamie Dimon, the CEO of JP Morgan Chase, was quoted saying, "When you see one cockroach, there probably are more. Everyone should be forewarned on this one." So if new cars are getting hard to afford and even the ones that we have are getting harder to keep, what's happening? In late 2001, Ford released the Maverick, their new pickup truck. It cost about half as much and was half the weight of the normal F-150. At the time, Ford just needed to get rid of its inventory, and this was the perfect way to do it. Starting at a base level price of about $20,000, the Maverick was a hit. It drew immediate interest from consumers who saw an opportunity to purchase a nice pickup truck without having to break the bank. But there was a problem. The truck became too popular, so much so that dealers began to sell them 25% above the average price during the first few months after its release. And since then, the price has continued to skyrocket. It's now at $28,145, a 41% price hike from 4 years ago. The Maverick is part of a bigger problem the auto industry is facing right now. Cars that used to be cheap and new, perfect for those in the middle class and young buyers, are becoming increasingly rare, thus opening the doors for automakers to raise the prices. I have a chart from The Hustle where I learned about all of this, and I'll leave a link in the description below so you can check that out for yourself. Earlier this year, the share of new auto sales under 25K was 4.8%. This isn't just an inflation thing, because according to Kelley Blue Book, brands like Hyundai, Dodge, Toyota, and Kia, who are known to be budget vehicles, saw prices skyrocket well above industry average from March 2019 to March 2025. But if you look at the same data from luxury brands like Audi, Jaguar, and Porsche, they saw very little increase. In fact, accounting for inflation, the average prices on those brands are lower than those in 2019. So if inflation isn't the problem, then what is it? Well, to answer that, we have to look at the early 20th century. And trust me, this will all make sense in just a moment. But in those times, cars were still new, and making them affordable was a quick way to get mass adoption. Now, this obviously worked, but as with anything that grows and becomes more widespread and thus becoming more competitive, it became less profitable for the companies. And it's not even so much about the profit margins that it is that whether manufacturers are producing a mid-sized car or luxury car, a lot of the fixed costs are the same, according to Christian Seabaugh, an editor for Motor Trend. This caused American brands to bleed for years on this small and mid-sized car. So they just eventually gave up. Now, most of the automotive industry's profits are kept under wraps, but analysts have estimated margins on trucks like the Ford F-150 to be 20% per vehicle. Not only that, but they also estimate that Ford F-150s account for 90% of Ford's total profits. So based on these economic factors, a lot of the once affordable cars like the Chevy Spark, the Dodge Dart, Ford Fiesta, and Honda Fit were just ditched by automakers. Now, given the scarce budget-friendly car market, this put automakers who still make these type of cars at an advantage because they can just raise prices. It's simply supply and demand economics. Take a look at this quote from The Hustle's article. "By having fewer options, you're killing the ability for customers to make a deal. Customers are now at the whims of whatever is left in the market." But it's not just the automaker that customers are at the whim of. It's the dealer as well. In the US, only 20% of buyers pre-order new cars. This is the complete opposite of European countries who pre-order their cars before even buying them. Most Americans just show up at a dealership and take what's available. This allows dealers to stock up on expensive models, which obviously is their preference, while keeping a low amount of cheap vehicles. But Ivan Drury, the director of the Insights of Edmunds, stated that it's not only the dealers and automakers' faults. The consumer is to blame as well. You see, most of us Americans have become accustomed to high-end car features like infotainment systems, cameras, and even heated seats. And nobody's moving backwards. They only want better when shopping for a new car. So I guess we're all a little bit part of the problem. Now, of course, we have to talk about tariffs. It's the elephant in the room. It's the elephant in all rooms. Even though a number of tariff deals have been struck, there are some deals and frameworks that are still not finalized. The current rates for exported vehicles between Canada, the US, and Mexico are still 25%. Those negotiations are still in limbo. Along with tariffs, pricier EVs are driving up those prices as well. With the expiration of the federal EV tax credit on September 30th, more EVs were sold than what would be normal. So, okay, prices of new cars are high. People are having a hard time finding cheap new vehicles. But we have to address a huge issue that is alarming. Repossessions are going crazy right now. George Baden, the president of the Allied Finance Adjusters Trade Body, stated, "We've seen some subprimes making changes, which probably indicates they're having issues. They're not financing cars like they were. 2 years ago, they were financing anybody." Now, is this on the same scale as the 2008 subprime mortgage crisis? Maybe, but probably not. But seeing these big brands collapse and file for bankruptcy has definitely caused everyone to take notice of what's going on in the industry. The bigger fear amongst investors is what repossession says about the wider economy. Because according to Brett House, a professor at Columbia Business School, the stress in auto lending broadly is often seen as a bellwether to changing circumstances in the U.S. economy. Because Americans, particularly in the lower income brackets, tend to put their highest priority in auto payments. Cars aren't essential to most of our day-to-day lives, so an increase in repossessions can be an indicator for Americans tightening up in their finances. There are an estimated 100 million Americans with auto loans, with 85% of new car purchases and 55% of used car purchases being financed. That makes it the third largest consumer credit market in the U.S., behind mortgages and student loans. These problems in the auto loan industry didn't just come out of nowhere. They've been looming for years. During COVID, car prices rose along with inflation and interest rates, taking the number of weeks of income it takes to pay off a new car from 33 weeks before the pandemic to 42 weeks in 2023, with the average monthly repayment being $750. Last year, car repossessions rose to their highest level since 2009. Loan operators are even giving out loan modifications to move back delinquencies. Couple this with high mortgages and rents, high grocery bills, and high auto loans, and you have something that's unsustainable. Now, I am not one to be doom and gloom, because I believe out of every crisis, if we think hard enough, we can find a way to innovate through it and create a better tomorrow. If you like this video, don't forget to subscribe, and remember, Jesus loves you.